How powerful is the dollar now? Naturally, there must be two items available for a comparison to take place. The dollar index, which measures the value of the US dollar in relation to a collection of international currencies, is a measure of how strong or weak it is in relation to those other currencies. In this video, we will be analyzing just how much power the dollar has on the world economy. The US dollar index has experienced significant ups and downs throughout history. It nearly reached a record high of 165 in 1984. In 2007, it reached an all-time low of nearly 70. During the last few years, the US dollar index has generally ranged between 90 and 110. The index is influenced by macroeconomic variables such as recessions and economic growth in various countries, as well as inflation and deflation in the dollar and other currencies included in a similar basket. Before we continue, it is safe to note that nothing in this video should be taken as financial advice, as everything being said is just for educational and informative purposes. That being said, let's move on. For a currency's value to rise or fall, it must either be too scarce in circulation as a result of inflation, or in high demand for transactions in other countries. The value of a freely traded currency typically reflects the likelihood of a positive return on investment in the country's assets. As a result, rising currencies are usually attributed to strong economic growth. Although not unusual, the dollar's sharp rise is undeniably significant. The United States economy's growth prospects are better than those of other top nations, and the Federal Reserve's monetary policy is diverging from that of other international central banks, as evidenced by the impending interest rate hike, ongoing stimulus policies. Because of the country's strong growth compared to other nations, interest rates in the United States are higher than those in Japan, Europe, and other developed countries. Due to these significantly high interest rate differentials, the dollar is more appealing to hold. Surprisingly, foreign investors, particularly major central banks, own more than half of all outstanding U.S. Treasury securities. Analysts are unable to accurately predict the world's economic situation. Nobody will do. A global recession is on the horizon, and everyone can only wish it was a nightmare that never happened. With the Federal Reserve showing no signs of slowing its rate hikes to combat inflation, Wall Street analysts are becoming more pessimistic by the week. If the economy enters a recession, Goldman Sachs predicts that the S&P 500 will fall to 3,150 in the next 6 months, while Morgan Stanley predicts the index will bottom out between 3,000 and 3,400 later this year or early next year, representing a 6% to 17% drop. Bonds and equities both fell at the same time this year, which is unusual. There is no safe haven anywhere, at least for the time being, with the exception of the US dollar, which has become resistant to all market downturns. After all, central banks are acting aggressively as inflation approaches multi-decade highs. Rising borrowing rates, high oil prices, and the conflict in Ukraine all cloud the outlook for economic growth and corporate profits. As a result, the S&P 500 index and the Nasdaq 100 index are on pace to have their longest losing streaks since their third consecutive quarters in the red. Bank of America strategists estimate that there have been 294 interest rate increases since August 2021, with $3.1 trillion in quantitative tightening over the previous 7 months. They wrote on Friday, the 30th of September 2022, that as a result, the global stock and bond market cap has fallen, and that the shock from rates and quantitative tightening has affected Wall Street's addiction to liquidity. Despite all of the economic uncertainty, the US dollar continues to soar in the market, maintaining its strong dominance over other countries. The US stock indices frequently rises in tandem with the global appreciation of the US dollar. Over the last 20 years, the rise in the value of the US dollar has had a somewhat positive correlation with the movement of the S&P 500 index. In other words, When the value of the dollar rises, the S&P rises roughly 40% of the time. Because stocks must be purchased in US dollars, it is conceivable that an increase in the value of the US dollar will increase the value of American stock indices. The central bank, on the other hand, is an institution tasked with developing fiscal policies that will assist the economy in achieving maximum stability. When inflation continues to rise, the central bank responds by raising the inflation rate and the interest rate. The ultimate goal is to reduce the amount of money in circulation while increasing the currency strength. However, while this is a fiscal measure that may benefit a country, it may harm the global economy in the case of the United States. The global economy suffers whenever the Federal Reserve raises interest rates, and the effects on stocks and other digital assets may be even worse. When central banks raised interest rates, Bitcoin traded a lot of risky assets like tech stocks, but that hasn't always been the case in the last month. Since the beginning of September, Bitcoin's value has increased, although not so much, while the tech-heavy Nasdaq has fallen by about 10%. When crypto bulls dig a little deeper, the image becomes even more terrifying. Bitcoin's value had dropped by more than half by 2022, outperforming most other currencies, stocks, and bonds. However, because the majority of Bitcoin trades are made against the US dollar, the dollar's performance is detrimental to cryptocurrencies. Almost 70% of all Bitcoin exchange volumes against fiat currencies are in dollars. However, it is important to note that one should not draw too many conclusions from this. In comparison to other asset classes, cryptocurrency is still in its early stages. Prices fluctuate for reasons other than, say, the strength of the dollar, because the latter has its own quirks. The dollar, however, has a strong hold on the stock and commodity markets. There is no single correct answer to the question of what a stronger dollar means for markets and the global economy. A stronger or weaker currency is not always good or bad in this sense, in the same way a stronger dollar produces winners and losers. Despite the fact that a stronger dollar raises the cost of exported goods and services, exports account for only 13% of the country's GDP, while domestic consumer spending accounts for 68%. A stronger dollar lowers commodity prices, which benefits countries that prioritize consumption, such as the United States, because many commodities, most notably oil, are priced in US dollars. Profits for the S&P 500 index currently come from foreign countries to the tune of about 40%. Many American companies that manufacture in the country but sell abroad have admitted that the currency strengthening will hurt their bottom line. A stronger dollar, on the other hand, lowers import costs and keeps inflation under control. A rising dollar may effectively shift demand from the US economy to economies around the world, while US unemployment remains low, limiting the country's ability to absorb additional demand without inducing inflation. Other global economies, such as Europe, may see an increase in exports as a result of the strong dollar. This should lead to a stronger, more balanced global economy in the long run. However, a rise in the dollar tends to have an immediate impact on the sales and earnings of American multinational corporations. This is due to the fact that earnings earned abroad are converted back into dollars at unfavorable exchange rates. Individual equities may be impacted to the extent that a strong dollar affects earnings. However, the stock market has generally performed well during periods of both dollar strength and weakness, as well as the inverse. There is no significant relationship between the two. A rising dollar has historically corresponded with both the best stock market years, 1995 to 2000, and the worst, the 2008 bear market. The economic expansion and stock market recovery did not suffer as a result of the dollar's weakness between 2003 and 2006, and they are unlikely to suffer as a result of a strong currency today. Working with a trustworthy advisor is highly recommended, as is monitoring your investments to keep them on track regardless of market performance, based on information that supports your financial goals. The dollar is expected to remain the world's primary reserve currency for the foreseeable future. Despite long-term concerns about widening US trade and fiscal deficits, Demand for dollars for international trade and transactions remains high. The majority of commodities, such as soybeans and oil, are traded in US dollars, which account for approximately 40% of all global financial transactions. Importers of those commodities must have cash in hand in order to conduct business. Exporters frequently keep money in short-term US Treasury bonds for upcoming transactions. The size and liquidity of the US Treasury market support global commerce and investment. Simply put, there are few alternatives to the dollar that meet these criteria. Although the euro is widely used in financial transactions, its fragmented bond markets and prolonged period of negative interest rates have limited its use. Japan, on the other hand, is unappealing due to its yield curve management and zero interest rate policies. Despite persistent rumors that China's yuan will become a major world reserve currency, capital controls prevent it from even being freely convertible. Overall, it appears that the fundamentals supporting dollar growth will continue for the foreseeable future. Investors should put as little money as possible into non-American fixed income instruments. When comparing the US dollar to other major international currencies, it's critical to remember that expats' price forecasts may be off. Analysts' forecasts for the US dollar are based on technical analysis of the US dollar, as well as fundamental examination of the performance of currency pairings. However, past success does not guarantee future prospects. Do your own research and keep in mind that your decision to invest is influenced by your risk tolerance, market knowledge, the diversification of your investment portfolio, and your level of comfort with losing money. However, it should be noted that this and other videos on this channel are solely for educational and informative purposes and should not constitute financial advice. Remember once again that you should never trade with more money than you can afford to lose. What are your thoughts on just how powerful the dollar is? Let us know in the comment section below. And while you do that, don't forget to like and subscribe to this channel for more educational videos. Turn on your notification settings to receive an alert when we upload the next video. Until then, do take care and stay safe.